A few things we're going to talk about generally. It's just about the different types of returns in commercial real estate. It's a big deal when it comes to property valuations on the brokerage side, but also on the appraisal side. Generally, when you're looking at the income approach to valuations for real estate, the big difference between the brokerage community and the appraisal community is how we look at the data. Appraisals are more rear looking, right? They're going to look at comparable sales that have sold in the last 12, 18, 24 months. They're going to look at a direct capitalization rate of net operating income from last year, 12 months, or maybe even the last year's full year P&L in there. The brokerage side, the ownership side, the equity side is forward looking, right? It's relevant to them what happened historically with the property, but they're not going to own the property in the past. They're going to be more concerned with what's happening in the future. And so the current income, and more importantly, the future income with those properties is going to be paramount to that. And so you have to be able to come up with ways to measure that investment and measure the risks of that investment. It comes out to a risk profile. So we'll go over a little bit about general total return is not just going to be cash flow, right? The most common measurement of investment returns out there in commercial real estate by far is the capitalization rate, but it's probably the most simplest blunt tool that's available because it is just a point in time, and any fluctuations that have to be taken into consideration are just minor changes in the capitalization rate. But in calculating total yields, there's a lot more that go into it, and I'm going to go through a series of charts here, and they're going to be talking about a total yield. And so that total yield consists of your cash flow that comes through there, changes in the cap rates, which is an investor sentiment based on the risk profile of that property. NOI growth, right? NOI growth can be anywhere from rental increases to operating expense decreases and so forth. And then just normal improvements in anything else that affects that cash and general return that's out there. Different product types and different geographies across the country have different levels of cap rates, risk profiles, and so forth. So we'll break all that down. And then, of course, I have to mention the difference between the institutional and the private asset classes that are out there. Institutional, because a lot of those are going to be public, has much more data and information. So when you read articles, when you look at stats, when you think of anything that is getting produced about data within commercial real estate, the vast majority of it is going to pertain to institutional quality assets because the data is so much easier to get, right? A lot of those are public institutions. They're required to produce it. A lot of them participate in data sharing programs, and so you can aggregate that data a lot better. But it's a very small percentage of the market. So I say that because it's very relevant. You have to be engaged with people who are local and active, like you guys, right, and like us, to be able to understand where the private client market goes into that. And there's definitely a change in expected rates of returns between the two assets. So generally measurements of return that are out there, different methodologies. These are kind of the top. There's almost an unlimited number of ways to look and measure returns on investment. But these are probably the most common. Return on investment, that's as simple, it's a percentage. It's as simple as what is the return I'm getting on the amount of money I invested into the project, right? It's very simple. Return on equity. That is different, right? It would be great if your equity was always going to be the same as your investment, but as you know, equity changes. The property value could go up, cap rate compression happens, and then sometimes, even though you don't want it, your equity could actually be less than the investment you put into it. So it's good to track both of those numbers. Cash on cash return is another percentage that's very simple. That just takes into consideration everything but what we call below the line, which is all expenses that are accounted for underneath net operating income. The big one on that is debt. So cash on cash return is a ratio of the amount of money, cash that you put into the investment, like your down payment before your loan, in relation to your cash that you've taken out of the investment after all of your operating expenses, including the loan payments. Cash on cash. Capitalization rate, that's the big one we mentioned before. That's the general methodology that's used across product types, across asset classes that are out there. And it's not really very effective because it's such a blunt tool, and it doesn't take into consideration potential changes that are out there other than just slight tweaks to the rate that's used. Internal rate of return, that is used more on the institutional side because it's so complicated, but that's by far the most effective means of measuring returns. It takes into into consideration everything that could possibly happen on your investment from your purchase into your sale. And so you have to have an anticipated hold period of when you're going to sell it, and then you have to make estimations or assumptions on what exactly going to happen on every aspect of the property between the purchase and the sale. So that includes any kind of capital improvements that you want to do. What's going to, if it's multi-tenant that's out there, if it's an office building like this, what's going to happen at the end of each one of the lease terms that's out there? Is the tenant going to renew? Are they going to renew at market rates? Are they going to renew for less than that? If they leave, is the space going to be vacant for long? How long? What's it going to cost for me to get a new tenant in there in terms of leasing commissions, tenant improvements, building upgrades, elevator maintenance, all of the kind of stuff, whatever could possibly happen in there. Reserve requirements, you have to account for that in an IRR, and an IRR allows you to do that. And then at the sale, you have to estimate what you're going to be able to sell it for. That's the biggest factor that affects this, and it's probably one of the most important, right? But that gives you a measurement of the appreciation that the property had from when you bought it today to when you sell it. So you can look at all of those factors that come in, and you just dilute down to a internal rate of return up front. So it's by far the most effective, but it's all based on assumptions. So the quality and comprehensiveness of your assumptions are going to be paramount in that, and there's no rules or standards to do it. So you can have 5 people put together an IRR on the same property, and they're all going to be completely different, and none of them are right or none of them are wrong. It all comes into your own perspective on what might happen in the future. Net present value is the only one that's not a percentage in there, but you can turn it into that. You're basically taking your internal rate of return, or the cash flow model that you put together for your internal rate of return, and then discounting back at an appropriate discount rate what you think that property value is going to be in terms of today's dollars. And you can do that for every year or every periodic period, month, quarter, whatever you want in there, and then look at the change for that. And the change in there is going to be a measurement of your return and how well you've done in the property performance. So let's kind of move into the data. This data, it comes from NACRE, if you can see it there on the left. This is the National Property Index. So the National Property Index is kind of what I was telling you about. All of the member institutional firms stick all their data into this one thing, and then it averages it all together. So this is nationwide, all product types, everything from hospitality to retail to multifamily. Everything is all kind of grouped in there. Big things to point out here is you can see the cap rate has an inverse relationship with the property value, right? Everybody understands a cap rate is the ratio of your net operating income to the property value, right? So the higher the property value in relation to the net operating income, the lower the cap rate. So they have an inverse relationship that's going in there. A lot of people are looking and expecting, as most of us in the commercial real estate world have been expecting cap rates to level out, kind of moderate for a while and start to pull back. They haven't. It's been unbelievable. There's a few specifics that are kind of coming in there in terms of geographic areas or product types or something like that, which we still expect to see. But for the most part, it's still going up. And you can look at a chart like this and tell we're at record high values. We've never been there since they've tracked all this data. Record low cap rates, record high values. This is taking out, so to come into factoring in returns, there's a lot of things that come into that. One is NOI growth, right? What goes into NOI growth? Well, one of the most important things is the occupancy of your property. So if you break down occupancies by product type, how have they fared over the last 15 years or so? And the big outlier here is office. As you can tell, office has generally always been an outlier. If you look at almost any market, except for maybe San Francisco and Manhattan, office is generally going to have the highest occupancy rate. Certainly the case here, it's certainly the case in most of the markets that are out there. But look at industrial, right? Again, not a big surprise. With the push over the last 5 years into e-commerce, there's been a huge demand for industrial product to handle the logistics, right? The distribution, the warehousing, that kind of stuff. And so the demand for industrial far exceeded the supply that's out there. Now there's a bunch of new supply coming to the market, especially in the port cities that are out there. Not so much here, but especially in the port cities. And so that will actually start to adjust here a little bit as that supply hits the market. But that's definitely been and has made industrial kind of a darling of the industry for the past few years. NOI growth by property type. This kind of shows really where we are. The one thing that I wanted to point out here, they correlate obviously with the recessions and market cycles, but retail right? Everybody has been looking at retail as potentially the outlier in terms of underperformance for NOI growth, rent growth, and so forth that's out there. And that was certainly a risk for a while. The majority of the negative impact on the retail industry has been confined to the malls, right? The super malls, the regional malls, especially in secondary and tertiary markets. But the good news about that is a lot of those were obsolete product, and they've been removed out of the retail world and completely repurposed. Think of rack space. This is no longer a retail property, right? So it doesn't get affected into the averages that are out there. Out of the ones that are, the space that has been vacated by the big retailers that are out there is getting backfilled with completely alternate uses. Grocery stores, fitness, gyms, hotels, apartments, theaters, entertainment, recreation. Not necessarily retail, but it's still doing that. And it took a while for the industry and the economy to see that kind of adjustment, which is why you see the growth in the NOI went down for a while, leveled out, and starting to take back up. This is a great thing for retail real estate. Cap rates by property type. Here's the cap rates broken down by all the different ones, and you can kind of oversee the NPI index. Again, that's averaging all of them that are out there. Another example of kind of how it tracks. You can see with the economy, but look at the compression that we've seen since 2009 down here between apartments and industrials. That was almost 2 percentage points on a cap rate in 2009 that separated those risk profiles from the two asset classes. Now it's less than 0.5% between all of them, right? That is a lot of cap rate compression from investors chasing yield, right? Everybody was throwing money into industrial, right, which was the highest cap rate for a while. It became a favored asset class, and it just drove cap rates down to now they're much more comparable with all of the other asset classes. Multifamily, you've probably heard about that. That has been an outperformer for 10 years now. They've had the longest run that anybody can remember for a specific product type in terms of impressively low cap rates, meaning impressively high values for going in there. A lot of that is because for two reasons, in my opinion. One, multifamily, you can turn the property around a lot quicker because it's all year leases or less, right? So if you come in and you buy an asset and you want to upgrade it, try to do an improvement project, upgrade the countertops, the appliances, that kind of thing, and kick up your rents a little bit, it's not going to take you that long because you don't have to wait long for those the suites to become vacant to do that, right? Generally, you can do that in a couple of years, have the whole thing. On an office building, they're signing 3 to 5 to 10-year leases. So you're going to not be able to raise those rents regardless of what you do to the building until those leases expire. And so it's a lot harder to see short-term turnaround times in there. So also just general demographics, right? All the trends of preferences of where people want to rent as opposed to own lately has fueled demand into the multifamily. But the other main thing that comes in there that affects cap rates for multifamily is the cost of debt. That's the only product type where you can get government guaranteed debt, Fannie Mae and Freddie Mac. That's a huge provider of debt and capital for multifamily acquisitions. And you can get longer amortizations, higher leverage, lower interest rates. Basically, investors can pay lower cap rates for multifamily property and still get the same returns they can get everywhere else. And so that's driven those cap rates down as well. Loan-to-value ratios. This is another effect on the total return that's in there. And again, I want to reiterate, if you look, these are all surprisingly low, right? So as a reminder, these are institutional assets. We're looking at data from the National Property Index, from the NAIC rate. They're all institutions. Industrials, by far, the lowest in there. The majority of industrial assets that exist out there don't even have debt on them. I mean, they're all cash. So it's a good reflection of what's in the market, but if you look at the private market, kick that up closer to probably 55, I would say, on average, that's in there. Effective interest rates, same thing. Look at multifamily, right? That is a direct relation to the source of the government guaranteed debt. You can just get lower interest rates that's out there, which juice those returns a little bit more. So other than that, they're all pretty comparable. They're within 20, 25 basis points across product types, which is shocking, really. So I love this chart. This shows all the different components of the return. Remember before when I said return was based on a handful of things. One is your yield, right? The other return could be in cap rate compression. Cap rate compression is a reflection of investors' risk tolerance to that product type or asset class in there. And so property values could vary significantly based on changes in that. NOI growth, that's increasing in rent or reducing your property taxes, for example. It just kind of goes down for those that aren't passed on to the tenant. And then other effects, capital improvements, reserves, and that kind of stuff. But look, since 1978, look at the consistency of that blue line of cash flow that's out there. It's varied, but it's basically stayed within that 5 to 7% range across all product types and asset classes. But the black line is property values, the total returns, I should say. Why are total returns going up and down so much? That's cap rate change, right? That is the investor's opinion of the risk of holding that asset in a recession as opposed to in a recovery. So that, as you can tell, greatly, look at the variation from probably positive 20% to negative 25%, just based on investor perceptions to the economy, when all of the rest of the fundamentals on there are pretty comparable. So that's what cap rates can do. Total returns, if you break out that National Property Index by geographies, this is just an example to show the difference between how the actual real estate, the town that's in there, can affect where it is. I mean, even major markets like Los Angeles and San Francisco will have a huge change in rates of total returns. And you have to go back and break down why is there so much movement and gaps and changes in there? Well, you have to go down and distill down to exactly what are the components of the total return. It could have been a market that experienced really high rent growth. Look at New York, right? San Francisco, Washington, or it could be markets that had a huge compression in cap rates. It's in there. We don't know, right? Because it's not broken down by that, but it could be any one of those things. So look specifically into the apartment market. If you break it down by the apartment style or apartment type, garden, low-rise, mid-rise, high-rise, you can see they're fairly consistent into where the cap rates are between the product type. But the thing I want to mention is the blue line with garden apartments. There has been a surprising change in demand from the millennial groups into garden apartments, which wasn't expected, right? The younger ones, the young professionals want the live, work, play. They want the mid-rise, high-rise, downtown urban environment. As they get older and they move into family creation, they're preferring suburban and preferring garden-style apartments. So we're going to see, I believe, the cap rate compression on that blue line to come down and get closer in line with the other product types that are out there. That last chart was cap rates. These are total returns, right? Same thing, but you're influencing more than just the cap rate changes. You're also doing everything else in there. And so you can already see the garden apartments total return is starting to come down. Investors have noticed it, and developers, and starting to bring more product to the market. So that's going to push those returns down until they start to adjust. Office. Office broken out by central business district and suburban office. It's out there, very, very correlated. But look how much just general returns or cap rates have compressed from basically 7% down to 4.5% just since the last time. 4.5% is just amazing for that. If you look at the total returns, same kind of comparison. We're in closer to that 10% range down to the 7% range. I bring these charts up there, and I'm sorry they're a little fuzzy because this is more of a reflection. This is not the National Property Index. This is a reflection of more of the private client mix that's out there. The top left chart shows the correlation between office cap rates and the 10-year Treasury. That was a big deal in the last boom cycle, right? From 2001 to say 2007, the vast majority of those acquisitions were financed by commercial mortgage-backed securities, and those were pegged, or they were priced based on a spread over the 10-year Treasury. And so fluctuations in the 10-year Treasury had a pretty big impact on cap rates, right? And so you could forecast where cap rates are going just by watching the 10-year Treasury. In 2008, the CMBS market completely crashed. It went away. It's back now. It's a shadow of what it was in the past, and it's no longer a preferred source of debt for especially institutional, right? for these kind of office products. So it's still there, but that's just more a reference just to show you kind of how debt has changed on there. On the upper right, that graph I bring up to show you really how the transactions are laid out on the types of properties and assets that are there. Like I mentioned, the vast majority of the market of transaction sizes are private client. We just don't have really good data for that, which is why we're always talking about institutional data. But institutions are going to be looked at as the green bar, stuff above 20 million. But as you can see, that's a very small portion of the market. Cap rates on the lower right, that's just looking at the trends between the central business district and suburbs. I point this out because I was mentioning there has been a preference for millennials as they start families to move out of their office locations in urban areas and into the suburbs. That's why you see the CBD cap rates leveling out since 2015, but the suburban cap rates are still coming down to meet those. That's property values going up. And then down here, this is another example of that. The gray lines are households that are expanding in urban areas, and you can, since the 70s, 80s, and 90s, those kind of have slowly and consistently gotten shorter. But that has been getting filled. Look at from 2010 to 2015, the majority of those people were moving into the central business district area. That trend and preference has now changed into the suburbs that are coming out here from 2015 to 2025. So it'll be an interesting trend to watch. Retail. This is, I think a lot of people I mentioned before, just based on all the press that was coming out there for retail, we're expecting cap rates for retail to kind of tank and hit the bottom, the Amazon effect, and then start to come back up. That hasn't been the case, right? They've leveled out. We actually believe that as the scare and the fervor of what Amazon might do to brick and mortar retail kind of subsides and goes away, there's not going to be any more of those alarmist type scares that are out there, and we think they'll continue to track with the rest of the national property index that's out there. If you're looking at total returns, you can kind of see how, as I mentioned before, the malls, the super regional and the regional malls were really kind of affected the worst by all of those. But they're coming back as they have been able to backfill a lot of that space that's come to the market. Those are going to come back in line, and you'll see a little bit more correlation between all the different product types. Breaking them down by multi-tenant to single tenant, upper left chart. Main thing there is their cap rates, values, price per square foot are still correlated, but generally there's about 100 basis point difference in those. And I hesitate giving you a general term like that. We'll go into it in a little bit because there is so much variation in the net lease world based on a lot of factors. And we'll go into the next chart here. We'll show you exactly what I'm talking about. Trends on the right, you can see the difference in risk profile that investors put on investing in primary, secondary, tertiary markets. San Antonio is full on a secondary market. Really the only primary market in Texas is Houston. Dallas is actually considered, if you could put the DFW together, it's a primary market. If you separate them, they're both secondary markets as well. There's a big gap. Most institutions won't even look in San Antonio for a lot of products that are out there, just to give you an idea on the size there. But because those cap rates are so low, because total returns on the Class A assets in the primary markets have compressed so much, they're moving into the secondary markets to look for yield, right? That's why you're seeing the gray line move closer down, and it will continue to move closer down to the Class A. That happens every time. Cap rate compressions between product types or asset classes and geographic areas will always compress once the Class A thing bottoms out, just because people have to get returns. Pension funds have to get returns. Insurance companies have to get returns. They've got to get that yield somewhere. And then rent growth is fairly correlated between the two that are out there. This is what I was talking about on the net lease sector, right? This is a lot of data on this chart, but just within a net lease sector, if you look down, these are all just examples of high transaction velocity tenants that get traded on the market nationwide. What I want you to focus on is that bar on the right side. So if you take any one of those, like let's say, look at Dollar General right there, 15,000 Dollar Generals transact out there. But look at the bar. How in the world can you have cap rates vary from 6% to almost 11%. It's the same tenant, right? It's the same guarantor on there. That is a direct relation to the amount of lease left on it, right? If you were going to go out and buy an asset for your grandma, would you want a good lease? Yes, of course you would. Would you want a lease that had 1 year left on it or 20 years left on it? Right? Of course, you'd want the longer one. So that's a reflection in the cap rate. So that's generally where you are, which is why I think it's kind of silly when people say, here's where cap rates are for single tenant properties. It varies too much. Nobody knows. It's overgeneralized, and it's specifically because of that. The orange diamonds in there are basically the median. That's about as good as you can say. The only other thing that you want, if you want to try to generalize, and you're just going to compare cap rates from tenant to tenant within the net leased world, is only look at product that's brand new out of the ground with new leases. That's the only way to really compare. Other than that, you have medians. There's just no way. The industrial properties are outperforming. Every one of them, warehouse, R&D, flex manufacturing, are all outperforming the MPI index across the board. That's going to continue until we flood and oversupply the market, which nobody sees happening anytime soon for that. Don't really know what happened with manufacturing, but even with that huge adjust in total returns, it's still outperforming the net property index. So hotels, right? So this is an overlay of general cap rates for hotels in San Antonio in comparison to the United States. It fluctuates a lot just because of the limited transaction velocity to smooth out those lines. But in general, it's about a 9% cap rate that's out there. If you didn't know, average hotel occupancy for mid-grade hotels is about 63%. Right, so that is what is expected. Above or beneath that would affect that cap rate a little bit, but they're going to come out to about 9%. Hotel returns. This is total returns. That one was cap rate. If you factor everything else out, this chart is on quarterly data. So average quarterly return on this is between 2 and 2.5%. If you look annually, that's between 8 and 10%. That's consistent with a lot of the other ones over. If you remember when we were looking back at total returns from office, retail, and industrial in the early part of the decade, in the 5 years, from 2008 to 2015, average returns were in the low teens, 11 to 13. In the last 5 years, they've been down in the 6 to 7 to 8 to point. So hotels are no different in there if you look at them on the average through there. Agricultural, just because we have the data, right, and it's an investment product type, they're looking in that same kind of range. They're probably in that 7 to 8% return. It's broken down by farmland and timber. Timber, over the last few years, has had to deal with a lot of natural disasters, mostly fires, hurricanes, that kind of stuff. And so they've been a little lower over the past, but in general, even agricultural land is kind of running in there. So what about people's primary home? So many people have been told that their primary home is their biggest investments out there. You're not going to take your primary home and get rental income on it, but generally homes, especially in Texas, we have a nice stable market, are going up in value. We should be able to measure that in terms of a return. Since 2011, property values in San Antonio have gone up, in Texas have gone up about 50%. That's roughly 7% a year, right? Right in line with what we've been expecting somewhere else. So generally, being able to measure investment returns in that is going to be critical for understanding property values wherever you are and in the potential for future income to continue. I would just kind of mention most of the product types, most of the asset classes, if you take a long-term average, they're all going to be in that 8 to 10% range. It's funny. Even though cap rates vary dramatically, even from product type or asset class, multifamily, Class A multifamilies are going for 3 to 4% cap rates, but their total return is still in that 8 to 10. Right? Just like you can go in and get retail and office, cap rates are in the 6 to 7 to 8% range. You apply debt, you're in the 8 to 10, right? So everything is kind of filtering out there into that 8 to 10% range. Moving forward, we've already kind of talked to the data, so specifically we expect multifamily to continue. There's still a trend for the majority of Generation Y and Generation C to rent, at least for the next 10 years, to prefer to do that until they start into family creation. But they might be preferring to rent more in the suburbs than we had expected in the past, which is exclusively downtown. And then, of course, industrial, for all the stuff that we've talked about that. So that's basically all I had. I appreciate you guys. Love to talk about some questions or anything that we can kind of cover a little bit more.